So I try to be very, and Melissa, is it okay if we record this?
Yeah, absolutely.
Okay, excellent. Well, this program, kind of Meet the Investor, is really kind of organized and put on to enable Spokane area entrepreneurs, startups, and tech companies to meet a variety of funding sources and to learn their investment criteria and to receive kind of update on market conditions from VC firms, private equity firms, and in this case, really kind of a novel form of a non-dilutive financing. But I'm going to kick things off today by turning it over to Lindsay Cornegie, who is with Witherspoon Kelly and is a sponsor of this series, to go ahead and introduce Melissa from Lighter Capital.
Sure, thanks, Tom. Melissa, I would like to welcome you on behalf of Witherspoon Kelly. We understand you have had successful exits as an entrepreneur and have worked as a venture capitalist in Silicon Valley and Australia prior to your current role with Lighter Capital in Seattle. I just want to say thank you for taking your time to speak with us today, and that we are looking forward to your presentation.
Thanks, Lindsay.
Excellent. And today's format is really kind of, fireside chat, very informal. I have a series of questions that I'm going to be submitting to Melissa. But, if anybody has a question, since we have a smaller group here today, just chime in and ask the question, and hopefully we'll make this as interactive as possible. But to start off, why don't you give us kind of a thumbnail sketch of your background, Melissa? And I believe you joined Lighter Capital in 2020. But what were you doing? What were you involved in before joining the firm?
Yeah, so going back to even before I met you, Tom, I was an entrepreneur. I ran two companies that both had successful exits, and both were Seattle companies. They both had very successful exits, 10 and 15x for the investors.
Nice.
And so, when that happens, you think you're pretty smart. And then I went into venture and funded people who are way smarter than I am, worked a lot harder for a lot longer, and didn't necessarily have those kind of exits. So I realized that luck and timing plays such a big role in those exits. But I went into venture about the same time you did, Tom, probably a little bit after. We did a couple deals with you in Seattle. I was with SeaPoint Ventures, not in Silicon Valley, but in Seattle. And then in 2009, I moved to Australia with my Australian husband, and got involved in the ecosystem, the whole venture ecosystem there, which was very nascent, but has grown quite a bit. And I was running National Australia Bank's Venture Capital Fund. National Australia Bank is a big bank in Australia, and I was focused mainly on fintech investments for them, and mostly in US companies. And one of the companies that we invested in was Lighter Capital. We invested along with Silicon Valley Bank. It's a Seattle-based company in 2018, and I went on the board. And in 2020, we needed to bring in a new CEO, and I just absolutely loved the company. And it sort of spoke to everything I'd done from the entrepreneur side to, I was also an active angel investor and a venture capitalist. So I applied for the CEO position and got it, luckily, because I was on those board meetings would be very awkward if they hadn't selected me for the CEO. But anyway, I've been doing that for 2 years. And Lighter Capital is the pioneer in revenue-based financing for SaaS companies. So we provide, it's a very cool product. We provide non-dilutive capital to companies with recurring revenue. And it was started because there's this big gap in the market. Tom, as an entrepreneur or as a venture capitalist, and like a lot of people on the call know, we fund, as venture capitalists, we fund 1 out of every 100 companies that we look at, venture capitalists do. So, I like to say, as a venture capitalist, I was in the disappointment business. I was constantly saying no to the most fascinating people on the planet, startup entrepreneurs.
And you have to learn to say no in a very kind way, so they walk away at least feeling they got some value out of it.
Yeah, and for the most part, they're great companies and great ideas, but so there's this gap in the market, like these startup companies that aren't profitable yet, that don't have hard assets, or the entrepreneur's not going to pledge their house if they're not venture backable necessarily. They're not going to get funding from the bank either. So there was this role in the market for how do these growth companies get funded who who can't access venture capital.
Yeah.
And look, some of our companies don't want venture capital. We have a subset of our entrepreneurs who just don't want anybody on their cap table. And then there's some that just aren't venture backable because the TAM's not big enough. They're great companies, but they're not going to be a unicorn, and venture capitalists are typically unicorn hunters. Yep. So that's lighter capital.
Okay. Well, let's drill down on some of that. So did lighter capital pioneer this notion of a revenue-based loan, or did they emulate other providers of similar capital?
So lighter capital was really the first to do SaaS funding at scale. Revenue-based SaaS funding at scale. Okay. Started in 2010.
So describe what a revenue-based loan is.
A revenue-based loan, so the way we structure ours is we provide the company with money and then they pay us back money, fixed amounts on both sides. So we will say, we'll give you $1, and depending on where you sit on the risk profile, you're going to pay us back on average, it's $1.35 over 3 years. So we'll say, Tom, we'll give you $1, you pay us back $1.35. We're modeling that that's going to be paid back over 3 years, and you're going to pay us a fixed percentage of your revenue until you hit that $1.35. Okay. So, and it's usually somewhere under 10%. So we'll say, here's that $1, pay us back 8% of your revenue until you've hit the $1.35.
Okay.
So where we do, go ahead.
No, you go ahead. You're probably going to answer my question anyway.
Well, where we do really well is if you grow quickly. So you grow way faster. We model to get paid back in 3 years, but let's say you just, shoot the lights out and grow way faster than we thought, then you might pay us back in 18 months, or if you get acquired early on. You're not paying us back more than that $1.35. You're paying us the fixed amount, but we get paid back faster. And the way we make our money is the spread between our cost of capital. So our cost of capital comes from Credit Suisse and some smaller debt providers, and then the ultimate rate that we get when we lend out our money. And we take no control. We take no equity, no warrants. There's no financial covenants or personal guarantees. So it's a great product. We saw this in COVID. If your revenues fall off a cliff. So, we've funded almost 500 companies now, and close to 1,000 rounds of capital, because most companies take more than one round of financing from us. But we had a company in the corporate food delivery business, and they got hit pretty hard during COVID. So their revenues went down 90%. And the amount they paid us went down 90% too, because we're getting a fixed amount, whatever it was, 6% of their revenue, and their revenue's down 90%. So they don't have this onerous debt burden, because it's always based on their cash collected revenue.
Right.
And on the flip side, in COVID, we had companies in the education space and also e-health that really did a lot better than we or they had forecasted. So we ended up getting paid back faster.
Okay, so if you loan a company $100,000, for example, on average, you would expect to get $135,000 back over 3 years.
Yeah, and that amount will be fixed at the time of the loan. We'll say
that amount is fixed.
It could be as high as 150, as low as 125, but 135 to 140 is about the average.
Is kind of the average. But the amount that is paid back every month fluctuates.
Exactly.
Because you might take the repayment mechanism is a percentage of revenues, which can range from, I think you said 2 to 8% or somewhere thereabouts.
Yeah, and it can really fluctuate if companies have seasonal revenue. So some of our companies, like in the ed tech space, they'll get paid a couple times a year when they do their invoicing. So it's based on their cash collected revenue.
Okay. And that 135,000 in my example is referred to in your materials as the return cap.
Yeah, exactly. And if you think about it from an entrepreneur standpoint, let's take a bigger size, let's say $1 million loan.
Okay.
So the fee on that $1 million loan is $50,000, right? So you're paying $50,000 for that $1 million of capital. So if you compare that to equity, say you were raising money, depending on what multiples are at, what ARR multiples are going for, but let's say you gave away, 10, 20, or 30% of your company for that $1 million. It ends up being quite inexpensive if it's a growing company compared to equity, compared to giving away equity.
Have you kind of boiled that down into some specific numbers that, again, just kind of averages that, the cost of your capital is X versus perhaps the cost of a Series seed investment or a Series A? Are you able to make any kind of hard number comparisons that are kind of based on the data?
It depends. It's all over. I mean, I love to give this example. It's such an extreme one, but one of our companies is a company called Seamless AI, which is a great product. And when they hit 3 million in annual recurring revenue, they had venture term sheets. They couldn't get venture capital before that. They tried. They're out of Ohio, and nobody wanted to fund a tech company in Ohio. But they decided to go down our path, and they took $2 million, non-dilutive loans from us, and they grew their revenue with that from 3 million to over 20 million. And then they did a big private equity round for in the tens of millions of dollars with the valuation in the hundreds of millions. Now they're a unicorn. But that's a husband and wife team, and they stand up and they say, we're personally worth hundreds of millions of dollars more today because we've got from that 3 million to 25 million in revenue without taking any dilution. So they still owned like 90% of the company when they did that big private equity round.
Right. Yeah, that's fantastic. And just to clarify, you said there's no personal guarantees, no security interest, no board seats.
We take a general security over the company, and that's just to, make sure there's no fraud or the company can't just move and start another business. But there's no financial covenants. We have a loan. We had a loan with Silicon Valley Bank, who's one of our equity investors and a great partner. But a typical bank loan, you've got a lot of covenants. So, and if you breach those covenants, then you're in default. There's zero financial covenants with our loan.
Okay.
We just basically give them money and say, how can we help you? Because we want the companies to grow fast. So anything we can do to help the companies grow fast, we'll do, which includes of what we do are introductions to people like you, introductions to investors. So when our companies are ready to go out and do that equity round, then we'll help them with their pitch deck and then help them also with warm introductions.
Okay. And you're really SaaS focused, so which means you're primarily, I guess, tech companies, but I guess a non-tech company can also have, some other form of recurring revenues.
Absolutely. We look for high gross margins, and that typically means a tech company, but we have examples of non-tech companies we've funded. And in fact, I think we should be funding more non-tech companies. We've been doing this for over a decade now. So we started with that pretty narrow focus, and we're broadening it to, anything, really any company where we can predict the revenue. And we're also looking at companies where if things do go wrong, they can downsize and still service their current customers. And a lot of times that is tech companies. You think of, SaaS companies, if they turn off, usually a lot of their expenditure is sales and marketing. So if they turn off that sales and marketing funnel, they can still continue to service their current customers. And we saw that with some of our companies had to do that during COVID, and they got through COVID that way.
Okay.
Can I ask a question? So
absolutely, yes.
You had said that you had to have a certain margin. Can you let us know? I'm not a tech company, but I do have recurring revenue. And so I was like, what margin do you need?
Generally, we're looking for 50% gross margins, but there have been exceptions. We make exceptions. Again, it's about being able to see what happens in a downside scenario. Like, for example, we had a company in the ticketing space. They're like a ticket master for small venues. They were growing like a rocket ship before COVID. Their revenue is a percentage of ticket sales. So you imagine, they give the venues their platform, and then they collect a percentage of ticket sales. you can imagine what happened during COVID. Their revenues were down 88%. But they were able to, it's a perfect example, scale way back and, you know, scale back really to a few people and keep the company going. And now they're ramping again, or they started ramping again a year ago as things opened up. So that's a long answer to your question, but we will look at companies with lower gross margins and see if, if they could withstand some hiccups. You know, if they have big fixed costs, it would be harder.
If someone wanted to use a company like yours, what are things we need to have prepared to show you?
So that's a really good question. The minimum requirement is $15,000 in monthly recurring revenue. And we look for low customer concentration. So if most of your revenue comes from 1 or 2 or 3 customers, it's probably not a fit. We're looking for a wide variety of customers. In business for at least a year and have revenue for at least 6 months. And in terms of the application process, it was always easy, but we've made it a lot easier. That was one of the things that we've really focused on in the last year. If you're a slow typer, it takes 10 minutes. We plug into your banking platform and your accounting platform and gather the data that way. There's almost no subjectivity that goes into decision making. So consequently, we have a much more diverse, group of entrepreneurs because we're not looking at team at all. So there's no unconscious biases that go into, whether to fund a company. I know as a venture capitalist, the primary thing I was looking at was team. And that's not something that we take into account at all. It's just the numbers. And the timing on it is, it could take anywhere from a few days to a week to a term sheet. And then funding takes a few days from there.
Greg Green. Was another question?
I do, Tom. Actually, I actually was just joining the call because I was interested in what you're doing. One, I'm having an exit in one of my businesses that I am involved in, so I think probably not appropriate on this platform. But if you have investors, I'd like to know what sort of the minimums are. As you said, credit. Susie is your bank, I guess now, but I would like to talk to you on the investment side. If you're looking for capital, outside. Okay. Now
who is that?
This is Greg.
This is the Tom Huseby of Spokane.
Oh, Greg. Okay. Hi, Greg.
Okay. So more appropriate to this call. So as an investor, I'm looking for places to put my capital. Is what I'm trying to say. Okay. Now more appropriate to this call, which I didn't expect this at all. We are acquiring a company outside of Chicago, in between Chicago and Milwaukee. They are a fiber optic and broadband provider. That's what my industry is from. We are looking, in fact, we're right in the middle of it. We have the company has $500,000 of recurring revenue with 2,400 customers. And the recurring revenues, on a monthly basis, what, 430, 440 a month. The net margin on that is 400,000 because we own the fiber or we own. So we have incredible margins, like, 85, 90% or more. But we're looking for 7 million. Now, this isn't we're actually talking to a lot of banks. So we do our work on a multiple of EBITDA, but it would be something I'd be interested in. 7 million is what we're looking for. Those are sort of the round numbers. That might be worth a conversation. I'll stop there. You can talk offline.
Yeah, no, I'm glad you brought that up because where we can supplement equity, but we can't be a replacement for an equity investor, we can lend up to 4 times monthly recurring revenue for companies with under 3 million and 6 times monthly recurring revenue. So if you're a high growth software company with 100,000 in recurring revenue looking for $10 million, that's a venture deal. We could give you at that point 400,000. It's, if you need that big chunk of capital to grow. But, we could sometimes be there to supplement debt. But what you just described, it sounds like really strong EBITDA. You might be bank fundable, and a bank funding
we
is
are, and I
a
just
lot
didn't
less
know.
expensive than ours.
Okay. Thank you for that. Appreciate your honesty.
You kind of touched on one of my next questions, which is kind of the range of the size of the loans that you made, and you threw out a couple of numbers there. You could lend, I think you said between 4 to 6 times.
Monthly recurring revenue.
Okay.
And the size of the loan is 50K, as low as 50K, up to 4 million.
Okay.
So it's quite a broad range.
So is it 4x monthly recurring revenues or ARR?
4x monthly.
Okay.
So we don't do a lot of 50K loans, but sometimes we do. Some early stage companies that maybe have 200 in annual recurring revenue.
Okay. So if a company is doing 50 grand in monthly MRR, you could loan up to 300,000 then.
Up to 200 on that case, because we go up to 6x for larger companies.
Oh, okay. Gotcha.
If they're under 3 million in ARR, we would go up to 4x
Okay.
MRR. So if they're 3 million or more in annual recurring revenue, we would lend half their annual recurring revenue, or 6 times their monthly.
Gotcha. This might be a little bit of an aside. Did you ever look at the early stages of Sonic Care in Seattle when
Oh my gosh, I'm an investor in that. I was an investor in them. And I was so lucky. Can I tell you my Sonic Care investment
Yes, because
story?
then I'm going to tell Bryn, if she is so willing, to tell you about her company. And I want you to finish, but I met David Giuliani very early on and unfortunately said no to his deal.
Oh,
I'm
no.
delighted that you did. And
So I was on a panel with David at Kellogg's house. Remember? I don't know when we. Anyway,
and where?
Gaylord Kellogg's house. I remember it was in his backyard. It was some panels, something we're doing. But then I found out later that he was pitching. He was raising money from Alliance of Angels for his company, this face wash brush. And I missed that Alliance of Angels meeting, and it was totally oversubscribed. So, but I called David, and I think this is where he wanted a woman as an investor, because it was a product that was focused on women. And so he let me in for like 25,000, and that was great. And he sent me a little, he sent me the product. He sent all the investors the product, and I just put it in my drawer and didn't do anything with it. And then I don't know, like maybe a year later or something, I'm getting a facial, and the person whips it out and starts raving about this product. I'm like, oh, so I should go use it. So I called David. I'm like, David, can I get some more money into this deal? And he said, oh, actually, we're raising another round. So I invested more. And anyway, that was a 21x. So that is still my best angel investment ever.
Wow. Well, Bryn, you want to share your new company a little bit?
Yeah. So my husband is a dentist, and we were looking around, and we realized that the best way to clean between your teeth is floss. But there's no electric flosser out there on the market. And we thought, are you kidding? How is there not one? And so my husband was like, well, we can't just have it be just an electric flosser. We have to make it so that there's something special about it. And so he created a special floss head that is like a 3-in-1. Not only does it have floss, but also has what we call gum sweeps, which is similar to like a proxy brush, and a tongue scraper. So you're able to get all of your oral health needs minus your toothbrush in one item.
Oh my God, that's great, because I hate flossing. Everyone hates flossing. We're supposed to do it twice a day, but that's awesome.
So we're really excited because our floss heads are like a toothbrush and they need to be replaced. And so we also invented one for braces that works with braces. And so super exciting, because there's 4 million people in braces at any given time.
God. That's so good. That's so good. I remember having braces. I had them as an adult. And like when you'd go to the orthodontist, they would take the thing off so you could floss. You were so excited to get in there and floss. So that sounds phenomenal. Are you raising money?
Well, a little bit like David Giuliani, she presented to our equivalent of the Alliance of Angels here in Spokane. And even before she was able to present, she was already fully subscribed. Now, fortunately, I said yes this time, unlike when I said no to David. And so I'm delighted to be an investor in Bryn's company. Sorry for interrupting, Bryn.
No, yeah, so we're super excited. We did our Series Seed round, and we just ordered a bunch of product. And once it gets here, we're going to go from there.
Awesome. Great.
Good. Okay, moving back to you. So if I'm a company and I am funded by you, and I've got this kind of 3-year term, but in, let's say, year 2, I get acquired. Well, are those loans then paid off? Are they assumed, or what happens in that scenario?
They're almost always paid off, because our loan will be Yeah, I would say they're almost always paid off. The times when they're maybe not is sometimes if there's an acquisition of two private companies merging together, and then we would say, yep, we'll keep it going with the combined parent if that's what the company wants. But I'd say 99% of the time it's paid off in that scenario.
Okay. And the payoff is just the balance between whatever has been paid and the revenue.
Yeah, say like on that $1.35 scenario, say you've paid 65 cents by that time, then it's the other 70 cents.
So if I'm a SaaS company and I'm growing and I've got 50% gross margins, and let's say I'm doing, I don't know, there's a company here in Spokane that's kind of doing $100,000 a month in recurring revenue, and they're evaluating their financing options. Why wouldn't they go to you versus a VC firm?
I know. I don't get it either. No, so no, there's, I mean, a couple reasons. So I was VC, you were a VC.
Yeah.
VCs get really involved in the company, and sometimes that cannot be great for the company.
Yeah.
But sometimes it's really good, and sometimes that 10, 20, or 30% you give to the investor is totally worth it because your company is worth 10, 20, or 30% more as a result of the investor's involvement and everything.
Do you really believe that, Melissa?
Well, it happens rarely. But I remember one company that we as investors completely messed up, Tom. So I mean, when I'm saying, just like you can see, we've seen dysfunctional boards and dysfunctional investors. But yeah, you can see I've seen investors who had a huge impact. But this isn't an either or necessarily, especially when it's small check VCs. So not only, the same math that applies for the entrepreneur in terms of avoiding dilution by taking non-dilutive capital applies to the early stage investor. So the angel or the venture capitalist, because if you think about you're an angel consortium coming in and the company needs 2 million and they're taking $1 million from you and $1 million from non-dilutive capital, and then you walk that through to the exit, you've made more money than you would have if they had taken 2 million in venture.
Yep. And is that common where companies are kind of mixing and matching the two forms of capital? Where they might be taking capital from you and then capital hypothetically from Madrona or Voyager or a firm like that? Whoops.
Yeah, it's common, not for bigger, which is, a typical venture debt. Oh no, and my internet connection is getting a little bit choppy. Is that okay?
Yeah, you're back now.
Okay. So, but it is very common with angels. And then what we do a lot of, and I think we're going to do a lot more coming into this market, is in between venture rounds. So if you think about especially today, you could have killed it and done really well last year. If you raised money a year ago, you're probably heading to a down round or a flat round at best today. So this is like a good way to avoid a priced round and to get growth capital.
Yep. Are you seeing your pipeline or your deal volume increasing in this crazy environment?
Yep, absolutely. And I think we're probably, when you think about Lighter's really only existed in a bull market because we started in 2010. So Lighter hasn't gone through what you and I have gone through, Tom, which is like 2008 and 2001, right? So this is maybe that again.
Right. Have you, has Lighter spawned competitors and others around the country or the region that are now doing something similar, or do you?
Yeah, there's a host of them. And what's really great is that I think for most of Lighter's existence, it's been educating companies and investors on what this is, because people have this negative connotation with debt. So you have to walk them through and, why this is good. And because this whole revenue-based financing space has proliferated, that's been great. So the market itself has grown and the demand for this product has grown because it's better understood.
Okay. Remind me, your geographic focus is what? Where does the company kind of have to be?
The US, and then in 2020, we opened Canada, and then in 2021, Australia.
Okay. And how do you kind of tell me about your team? How do you identify opportunities, or how do companies apply for a loan, and what's the loan approval process? I think you did mention that sometimes these can be approved as quickly as 4 weeks, but just kind of walk through, how you find companies or how companies find you.
So a variety of ways, but a big way is from referrals from people like you. So, you're in the disappointment business where you're saying no all the time, right? And I know when I said no as a VC, I always wanted, if I wanted to give them something, someplace else to go, or, give them something of value. So we get a lot of referrals from other investors and VCs who not only with their own portfolio, if their own portfolio is raising money, but who might come across companies that aren't a fit for them, that could be a fit for us. We have a partnership, with Silicon Valley Bank and with NAB. So other partners that refer, it's just generally the startup ecosystem making referrals.
Okay.
And we do
I might
LinkedIn advertising.
I might just kind of pause there and see if there are any questions from people in attendance here.
Yes, I have a quick question. This is Chris Maldi.
Yes.
Thanks, Melissa. I was just wondering if you could put a little finer point on your return requirement between the 10% versus the 35% that you talked about. Is if you want, is it based on industry or company size? What makes you decide if you want more like maybe even, I think you said the 50% is the kind of top range of what you look for versus 10%? Could you just give more details on what you do to either spot?
It's usually about 1.25 to 1.5. 1.5 is really the upper end. 1.25 is really the lower end. And remember, that's over 3 years.
Right. Okay.
So that's not like a 50% interest rate or a 25% interest rate. That's the fee paid over 3 years. So what goes into that, there's so much that goes into our rating card, but it's taking all the data. It's looking at churn. It's looking at customer concentration, time in business. We don't really look at sector. So, but there's different ratios that are looked at as well in terms of burn to runway. So if the company's burning a lot of money and has a much shorter runway as a result, that would put the risk way up.
Great, thank you.
I had another question following up on that, but I forgot what it was. Now you also, looking at your website, you also do provide kind of more traditional term loans and forward commitments. I guess I understand what a term loan is, but what do you mean by a forward commitment?
A forward commitment is if a company, say, qualifies for $1 million but only wants 300,000 now. We could say, take the 300 now, you could take 700 in the next 6 months, as long as your company doesn't change materially. Okay. So it gives you that option to draw more later. And a term loan is just a standard loan, fixed principal payment every month. Yeah. So there's predictability. So the company knows exactly what they're going to owe every month. So you don't have that downside. There's not the downside protection where it's not based on your cash collected revenue. Right. But I think probably 3 or 4 years ago, Lidar introduced that product because they found that some companies just wanted, they wanted a fixed amount.
Yep. And those are companies that are probably just highly confident in their projections.
Yes. Yeah. Exactly. Yeah.
Okay. I recall what question I was thinking of a minute ago. If I were to kind of relate the venture capital stages, pre-seed, seed, Series A, where typically are you playing, if typical even applies?
Yeah, I think typical does really apply, although we have everything. We have companies with over 20 million in our portfolio in revenue, and companies with as little as 200,000 in our portfolio, which would probably be seed. But I would say on average, a company has, when they take their first financing round from us, has between 1 and 2 million in annual revenue. So where you would put that at maybe between seed and A.
Yep. Back in the day, it might have been an A round, but not so much anymore.
I know. Remember we had A, B, C, D, E, F, G, H, I, J. Yeah, now we don't have that.
Alphabet soup.
Yeah.
Yeah. And if I were to kind of go and pull, some of the VCs that we all know, what would their commentary be about companies that pursue this path of financing, or if it's proposed that we kind of mix and match? What are kind of the general reactions you get from the VC community?
So I think now it's pretty well understood. So there's no negative if you have this kind of financing. There shouldn't be any negative signaling if you have this kind of financing and you're going out for a venture round. It can't hurt at all. It shouldn't hurt at all. I mean, Tom, you and I know that what can hurt is if maybe you did your first round with an investor that subsequent investors don't necessarily want to co-invest with.
Yeah.
Or if you did your first round with terms that are going to make it difficult to get your next round. So the nice thing about this is, we're not an investor that has any control in the company. You're just as a percentage of your revenue. There's no terms, there's no wacky, terms. There's no hair on the deal. So it's really clean.
Yeah. It just seems like just a marvelous solution for someone that otherwise meets your criteria. If they're growing, they got 50% gross margins. I personally, having been a VC before, wouldn't necessarily want to go through the headache of what comes with that form of financing. And
yeah.
I'm kind of sharing my cards a little bit too much, but I'm a little skeptical of the VCs that talk about all their value add, because I've been a little disappointed by how they don't really live up to expectations as part.
Well, I know, and Tom, we were in VC in the same time in the Northwest, and it was just a bad time to be a VC. Let's face it. Like, it was good in 2000, and then things got really bad, and it was just down round. Down round was like the best case scenario. At least you were getting around, or pay to play, washouts, layoffs, and then when that started recovery, you had the global financial crisis. And I just think back, VCs were for the most part replacing their founders, right? Because things weren't going right. So they would replace the founder. And typically that didn't make things better. It almost made things worse, right? Because so VCs, I think, have gotten a lot friendlier in the last decade, but then the market's been really good in the last decade. We'll see what happens, in terms of the founder friendly VCs when the market, if this indeed is a market shift.
Talking about down rounds and all the things that go with it, I can ask you a question for which you can dodge. But what has your default rate been, or is that something that you publish or talk about, or anecdotally can you share? I presume not 100% of your loans have been repaid, but did I cut out?
It cut out, but I think you're asking what
your default rate is. We brought up kind of down rounds, and not every deal works out.
Yeah, and we have losses that's factored into our model, just like VCs, not the rate that VCs have losses in, but our companies, sometimes companies don't work out, right? They go out of business. We've never taken over a company. Usually if they have no revenue, we get paid a percentage of the revenue. So if they have no revenue to pay off the loan, there's typically nothing there. But we see that coming way in advance. So it's modeled to be a 3-year loan, and we'll see way in advance if it doesn't look like the company's going to be able to pay it back in 3 years. So we can start having those discussions early and say, should we help you get equity support? We see that happening, but that said, we have companies that aren't going to make it through. We try and help them to the extent as much as we can.
In that instance, are you the top of the food chain then in terms of repayment and waterfalls?
We're almost always the only debt on the cap table. Sometimes if they go on to get a venture round and like Silicon Valley Bank comes in, we'll subordinate to them. Sometimes they might have an EIDL loan from the government. But we're typically the only secured creditor in the.
I was going to ask about that. It's Greg Green again. I was going to ask about that. Let's say that you had a line of credit with a bank, a small company. In order to do something with you, I'm guessing the bank would have to subordinate their position, because usually they have
No, banks
Or is
will
that not
never
correct?
subordinate.
Yeah, okay.
They won't subordinate. So that does come up.
Right.
We'll see if there's a line of credit with the bank. A lot of times it's an unused line of credit that companies have, and they're not using it for some reason, like it's too onerous to use, or maybe the ratios aren't right. But we have a number of scenarios where we're subordinating. Typically it's to Silicon Valley Bank, to either a line of credit or a loan with Silicon Valley Bank.
Thanks, Greg. Again, I'll take this opportunity. Are there any other questions that the group might have? Don't be shy.
All right, I'll try one. I don't know if you can hear me though.
I can.
Are we on? Okay,
Yep.
thanks. My name is Graham. This is going to be a little bit out of left field because I'm not the SaaS company or probably anywhere close to it. But like anybody who's starting a business, I have financial concerns and we need to grow. And in this line of work that I'm in, we've invented a battery that simply never runs out. So it blows a lot of people's minds, right?
Yeah.
This isn't supposed to exist. And so one of the troubles, I think, in a lot of hard technology where we're dealing with, circuit boards and real mechanical equipment is that, everybody wants to pile on when you've got the next greatest thing since sliced bread. But you have to show a working prototype. And the working prototype, of course, doesn't build itself. And so the model of paying back, what you have talked about here is brilliant. I love it. I love it because then a company gets to keep its soul, right? It does because it's not dilutive, right? So if you want to be a force for social good or things like that, that dilution tends to destroy, you can retain it. In our position here, right, we've got to come up with something that is a working product that multiplies out into the market. So we're very, very, very pre-revenue. In fact, we're doing stuff that even physics says is not possible. It's kind of too bad. We have global warming to show for it. Because if this was more regarded as possible, somebody would have done it already. So if you had somebody come to you and say, okay, that's crazy talk, maybe that business will fail. In fact, 99% odds it will fail, right? Who believes it? How do you get an investor to take a non-dilutive stake, but say, okay, say you have revenue in the future, but we're going to go for a lot more than 135%, right? Because you're that much more speculative. So it's going to be 700% or 7,000%, but you'll be in the business that can afford it. I know this probably sounds really crazy, but that non-dilutive investment is very important for companies that want to keep their soul.
I don't think it's crazy at all. In fact, I was just talking with an angel investor in Silicon Valley a few months ago who was saying they structured something just like this. It was a pre-revenue company and they structured, and it was, a pretty big payoff. I want to say it was like it was a percentage of revenue until they hit like 3x or 5x. So, it's much bigger. It's not like 1.3. But it's exactly what you said. They sort of said, okay, we want to get paid back when you start hitting revenue, but we're capping our payback at this. And it was a big cap. But I mean, and the advantage for that investor is they're not waiting for an exit. They're not waiting until you're acquired by Tesla. They're getting paid back along the way as you get revenue. But so I don't think that investors would be opposed to that. I would put it out there.
Well, that's why I spoke up. Thank you.
Yep. I mean, it's a very novel approach. And one thing I've witnessed is, the way that the venture capital industry is structured and the type of investments that they make really hasn't changed a whole lot since the 70s. And, VCs are all about innovation and change and new and different. But the way they invest really hasn't changed that much. There's not a whole lot of difference between saying, hey, pay me 7x revenues sometime in the future, or I own 20% of your company. The only difference is we've kind of capped the upside, but in each case, it's kind of just a unsecured, position in the company that if the company goes away, nobody gets things anyway. Right. So, I mean, the only problem, Graham, you're going to run up against is, the VC industry is so set in the way things have been done, and the way they get capital from institutional investors. If they were to do something wacky like this, it's just too different for them. But I think at its core, your idea kind of has merit. It's just finding enough investors, and it's more likely to be maybe a family office or an angel investor who might be open to something that's less mainstream.
Yeah, that's right. Well, you guys are my first call, so thanks for being here. This is
Good.
awesome.
Well, thanks for joining. Hey, so Melissa, I kind of want to just you talk about maybe Spokane here. So you're investing in Australia and Canada and throughout the U.S. Have you ever looked at anything in Spokane?
Yeah, in fact, when we were supposed to do this, when I missed it a few weeks ago or a month ago, I had looked up we had done a company in Spokane. And if you give me a minute, I can probably pull up the name. I mean, it was a while ago.
Okay.
And I think the founder's like living in Hawaii now or something. He had a good exit, if I remember correctly. So let me not
Greg Green.
Let me check. I could have it mixed up, but ask the next question. I'll see if I can find it while you're.
Okay. Well, the next question, I'm kind of moving toward kind of more broader advice, but one thing, Spokane is really when I think of Spokane, I really think of Spokane to Coeur d'Alene to Sandpoint, kind of a region here that offers some interesting quality of life attributes. And this region has benefited well during the pandemic because people can not only work wherever they want, they can leave Seattle or the Bay Area. And in addition, the companies that are based in Spokane now can cast a wider net when they hire people because the embracing of remote work. So I guess my question, kind of just from a 30,000 foot view, is what particular advantages or disadvantages might you see for an emerging company that is based in Spokane versus Seattle or Austin or Sydney?
Well, let me go back. I found that name, and then I'll answer your question.
Okay.
So the company that we funded is called in Spokane called Proxio. Oh, they started in the Bay Area, but then relocated.
Well, how interesting, because they merged with a company in Spokane called Collabra.
Yeah.
I'm now an investor.
Collabra.
I'm an investor in Collabra, on the board of Collabra, and was in a board meeting yesterday in Seattle in Bruce Prim's office, who's on the phone here for Collabra. So
okay, so there you go. That's they started in the Bay Area and moved to Spokane. So there must be some story there.
Yeah.
Because usually you would think the opposite, right? But look, it's completely different, right, than it was pre-pandemic, and certainly way different than it was 10 years ago. I mean, now these regional hubs, I was just spending time in Nashville, and these regional hubs are, Nashville's thriving, and I heard Andreessen now has a partner out there. So people are, I think, much more attracted to these, regional hubs than they were before. So I don't think there's any disadvantage. And the fact that, Seattle's all remote. Not Seattle, Lighter Capital is all remote now. We were 100% in Seattle before, and now only about a fourth of the team even live in Seattle, which is great, which means we can hire the best people from wherever. They don't have to be local. Yeah. So I would say it's a better time than ever to be starting companies in regional areas.
Do you still have physical offices in Seattle or other places, or is everyone really working?
Luckily, we got rid of our $50,000 a month rent in the Washington Tower building.
Wow.
I know, or the Washington Mutual building. Yeah.
Yep. Huh. So kind of a little bit back to Graham's question, you've one of the real values of you, Melissa, unlike other providers of capital, you've kind of seen this from all sides. You were a founder, you've grown a company, you've had exits, you were a VC, you were a personal angel investor, and now you're running Lighter Capital. So your sphere of influence, or your frame of reference is valuable. What kind of your general advice, based on your years of experience, would you offer to kind of, people like Bryn and Graham and others who might be on the call who are starting their first businesses? What advice do you have them, maybe just, about starting a business or about raising their first couple rounds of capital?
Well, I think that this is advice you'll hear all the time, but really be careful who you take money from. It's like it is getting married. And, you hear that advice all the time, be choosy. The reality is, most companies don't have a choice. Very few companies have like term sheets from VCs and they're picking which one to take. Most are lucky to get a term sheet at all, but you are better off not taking money than taking money from the wrong investor. That can really, just lower the probability of success. So just make sure that you're working with someone who's completely aligned with your vision as the founder, and wants to support you, to realize that vision. I mean, it sounds simple, but it's just so true. Things go wrong when that's not the case.
But how do you vet that out? Because, VCs are smart people. They're charming. They're good salespeople. They're nice. How do you really vet out what they're going to be like at the first board meeting?
Yeah, I mean, you have to talk to a variety of founders that they've worked with, not the list that they give you, but luckily this is all public information. You can find which companies they've invested in before and talk to their founders to see how they are to work with.
Yep. And that's the advice I give. And it's somewhat awkward to start kind of calling up portfolio companies of a VC. But one thing about being an investor, you look at signals from the people because you're evaluating the people. And if someone were to actually kind of check up on the companies I invested in and did reverse due diligence that way, I would go, wow, this person is smart. I actually like this person. They do their homework. And so I would look at that and go, wow, if they're that careful about their decisions and they do that work, I want to know more about them.
It's only a positive, right?
Yeah.
Right.
I just want to add something. This is Greg Green. I would also not, like you said, not call the people on the list they provide. Maybe call some of the companies, but I would also call others in the industry. I mean, you just be surprised to find out. It's the best due diligence you can do because you will be married to these people, and it's sort of you will be married on a business side with these people, and trust me, they will go from calling you every single day to the smartest guy in the room when it's done. Been there.
Yeah.
So true.
And then another question, because I'm a little less so now, but Melissa, you know me, and I've always kind of been the conservative guy from Spokane that sometimes didn't get the 2000 market dynamics.
Rightly so.
And last year, I was also kind of the conservative guy, kind of scratching my head on, why should I invest in a safe? Tell me why this valuation makes sense. Any kind of thoughts about, structure and valuations? I mean, I do find myself, and I don't, I feel badly for the companies, but, some companies last year that did safes or had too high evaluations now are kind of coming to regret the ramifications of that. Yeah. But how do you kind of advise somebody on, valuation and whether you do a series seed or a safe or a convert or any other form of investment?
Yeah, well, I mean, these days, just because valuations are under so much pressure now because of what's happened in the public markets, everybody will be feeling this pain. But if you go to a normal market, one of the biggest mistakes I saw companies make was taking money at too high of a valuation from unsophisticated investors and not taking enough money where it's going to be the last money they ever have to take. And then they have to go out and try and raise another round, and they're stuck with this high valuation. And it's very hard to explain that to an entrepreneur. It's not about the evaluation. in your early stage. The only valuation that really matters is the one at the end.
Yeah.
Make sure you have enough of your company by the time you get to that point. But that's just, I've seen it just be a company killer when companies do that, and they'll go out and they'll raise from, some new angel, and they'll raise on a $10 million pre, because their company could be worth $1 billion if they make it. So 10 million pre sounds great to the angel, and raise $1 million, and maybe they make some good progress, but then, going out for that next round is really difficult.
But it's so hard to give a first-time founder, that advice in a market like we had last year, because of course they're going to be the one company that this scenario doesn't apply to.
Right. Well, I remember raising money for 7 Software, and it was actually Doug McKinsey from Kleiner, who, we got pretty far down the path with them before we were acquired by Concur, but who said, Melissa, you shouldn't worry about valuation. You should worry about getting the right partner on board and growing. And I left Kleiner Perkins' office, I was 20-something entrepreneur, and just thought, he must have thought I just was born yesterday. I didn't hear that. Of course, that advice was absolutely true, but as an entrepreneur, you're not going to hear that you shouldn't worry about valuation and think that's good advice from a VC. You're going to think they're trying to, get a good deal.
Yep. Well, we just have another minute or two left here, and maybe I'll just open up one last time for any questions that anybody in attendance might have. Well, hearing none, Melissa, thank you very, very much for your time today. I think your form of capital is just, fantastic in the situations for which they meet your criteria. And, hopefully in the near future, we can find some opportunities here in Spokane. I'm already thinking of a couple in my mind that might work for you.
Well, thanks, Tom. I love what you're doing, and it's great to be reconnected with you after so many years.
Yep. And if someone, what's the best way for someone to get a hold of Lighter Capital if they want to learn more?
Feel free to reach out to me. LinkedIn, I'm always on LinkedIn, is good. Or Melissa at lightercapital.com. And our website is just lightercapital.com. There is a pre-qual application on our website, lightercapital.com-apply, which takes less than a minute just to see if you might qualify, which ask those questions like, do you have at least 50,000 in revenue and that kind of thing.
Okay, good. Well, thank you again. And thanks, Lindsay from Witherspoon Kelly, for sponsoring this. We always kind of take the summer off, so our next one won't be until the fall. But thanks, everybody. Have a wonderful 4th of July weekend, and we'll do this again in the fall.
Thanks, Tom. Bye, everyone. Thank you.
Bye. Thank you.
Thank you.
Bye.
Thanks, Brand.
Thank you.
See you, Bruce.